My name is Michael King, and today we're going to be talking about the weighted average cost of capital, or the WACC. The WACC is the weights of different forms of capital used by a company to finance its assets, weighted by their market values. So we can think of the WACC as an estimate of the average cost for each $1 financing that a company has raised to finance its assets, and sometimes it's referred to simply as the cost of capital. By capital, we mean all sources of longer-term or more permanent financing for the company, whether it's debt, could be bonds or loans, and shareholders' equity, whether it's common shares or preferred shares. For the purposes of the WACC, we ignore most forms of working capital, such as accounts receivable, trade finance, and non-debt liabilities. So the WACC actually shows up in the textbook by Booth, Clear, and Rikita in a number of chapters, 13, 14, 20, and 21. When it shows up in chapters 13 and 14, we're looking at the discount rate that's used for capital budgeting, which is a process of allocating capital or making investments in assets. In chapter 20, which looks at the cost of capital, WACC comes up in various forms, but the discussion in that text is quite long and confusing with many formulas, so we're going to focus only on what we need today to calculate the WACC and understand it. And chapter 21 is about capital structure, which is the choice between debt and equity in financing a company's assets, and that's covered in a future class. We've actually studied most of the WACC inputs already, namely, what is the cost of debt, which is going to be the yield to maturity on a corporate bond for the issuer. What is the cost of equity, which we've shown can be calculated using the capital asset pricing model, or alternatively the dividend discount model. And we've talked about the tax deductibility of interest expense, which is a subsidy that reduces the cost of debt to a company. So with these tools from time value money, we've been able to value debt as well as equity. And the choice of debt and equity is capital structure. With these inputs, we're able to calculate the weighted average cost of capital. Here's the formula as a preview for what we're going to be talking about. Notice that in this case, there are only two terms. There is the cost of debt, KD, on the left, multiplied times 1 minus the marginal tax rate, weighted by the amount of debt over debt plus equity, plus the cost of equity, weighted by the amount of equity in the capital structure. So there's a lot of terminology used when talking about the WACC, where you're going to talk about the cost of debt, which may be referred to as yield to maturity, the cost of equity, which we are going to typically use the capital asset pricing model, which, as you recall, is a theory about what the required return is for a company's equity based on a risk-free benchmark plus the beta or sensitivity of the company's stock to market risk multiplied by an equity risk premium. So the formula may have three components if preferred shares are a permanent form of capital for the company. Many companies don't have preferred shares, so often we just see two components, debt plus equity, where equity here is common equity. We found that you can determine the cost of debt using this formula, which is where we back out the yield to maturity, looking at the coupons, their timing, and the price of a bond. The cost of preferred, we saw, is typically estimated using this simple formula. So if we can observe the price for the preferred share, we can back out what the implied cost of preferred is. And for the CAPM, you can see here that we need to know what the beta is for the company. We observe the risk-free rate as a long-term bond yield 10 years or greater, and we have an equity risk premium, which for North American stocks is between 4 to 6%. We did talk briefly about how you can back this out from a dividend discount model with constant growth. However, this method is not generally recommended because many companies do not pay dividends, and it is quite difficult to forecast a sustainable growth rate. So when we think of the cost of capital, we can think of it alternatively as the minimum return that investors require to invest in a company. Because investors have opportunities to invest in the bonds of other companies or in stocks of many different companies, the CFO needs to understand what the alternatives are when comparing their firm to other firms. So So the required return by investors, looked at from the point of view of the company, is the cost to the company of raising the capital. So as you can see, the cost of debt is actually the return or yield to maturity on bonds, the cost of preferred is the return on preferred shares to investors, and the cost of common equity is the required return on the common, which is made up of both dividend yield and dividend or income yields and capital appreciation. So let's take a look at how to calculate this. Here we have an example of a company with a cost of debt of 6%, a cost of equity of 9.5%, a marginal tax rate of 35%, and the company has $30 of debt and $70 of equity in its capital structure, both measured at their market values. Notice that the marginal tax rate is used, not the effective tax rate, because we're looking at the long term into the future, and a company that's able to reduce its taxes in the short term using different options available under accounting will still be held responsible for paying those taxes back in the future. That's the assumption behind using the marginal tax rate. Putting these inputs into the formula, we see that we weight 6% times 1 minus the tax rate, so we take 65% of that, and we weight it by 30 over 100, or 30%, and we add 70% multiplied times 9.5, the cost of equity, and we get that the weighted average cost of capital in this case is 7.82%. Notice that that weighted average cost of capital falls between the nominal costs for both debt and equity. So in summary, the weighted average cost of capital is simply the average cost of raising funds where the weights are based on the company's capital structure. You can think of it as the average return expected by different capital providers. It does depend on the choice of capital structure because that will affect the weights. And it depends on current market conditions because we're going to be looking into the current cost of debt, which is a forward-looking measure based on where bonds are trading, the current cost of preferred, and the current required return on equity or the cost of equity. So we think of the WACC as the discount rate that a firm must earn on its investments to satisfy all the different capital providers. And it is the hurdle rate that is used when evaluating investments, which is going to be the subject of a future topic on capital budgeting.